Welcome back to the Daily Crypto Roundup. And today's episode is one of those days where crypto reminds you what it really is. A 24/7 global risk market that reprices fear faster than almost anything else on Earth. Because over the last 24 hours, we've had two forces collide at the same time. First, the slow burn pressure that's been building for weeks. ETF outflows, shaky momentum, and that every rally gets sold tape. Second, a sudden geopolitical shock that hit while traditional markets were either closed or illiquid, and crypto was the easiest, most liquid sell button available. So yes, the headlines look dramatic. Bitcoin sliding under $64,000, XRP getting smoked, oil ripping in on-chain futures. But the bigger point is this: none of this is random. We knew the setup was there, not because anyone can predict a strike or a headline, but because the market structure was already fragile. When flows are negative, when liquidity is thinner, when sentiment is jumpy, and when key technical levels are sitting right below price like trapdoors, you don't need a lot of force to push the market down the stairs. And that's exactly what happened. Now let's walk through what's actually going on and why this sell-off makes sense in the context of what the market has been signaling for weeks. The first story is the shock catalyst. Reports that the United States and Israel launched coordinated strikes on Iran, and that Iran retaliated across the region, with fears rapidly growing around escalation and energy supply disruption. This is being described as a major regional escalation with global market implications, including the kind of scenario where oil risk premiums get repriced instantly. And here's the key crypto mechanic. When a scary macro event hits, crypto usually doesn't behave like digital gold in the first reaction. It behaves like a high beta, high leverage risk asset, especially in the first wave, because it trades 24/7, it's liquid, and it's packed with leverage that can be forced out. That's why you saw Bitcoin lurch lower on the headline flow, and you saw the usual second-order effect where altcoins, which are basically beta on beta, got hit even harder. But this geopolitical hit didn't land on a strong market. It landed on a market that was already bruised and limping. Bitcoin is on track for one of its worst sustained stretches in years. The kind of multi-month grind lower that doesn't feel like a crash, but slowly bleeds confidence. A lot of that pressure has been coming from the most important marginal flow source of the last cycle: US spot Bitcoin ETFs. Sustained outflows have been tracked for weeks, framed as institutional de-risking while Bitcoin trades in a pressured band. And when ETF flow is negative, it's not just sentiment, it's mechanical. It is literally reduced marginal demand. Crypto quant's Julio Moreno has been cited discussing this flow deterioration, and Rania Goulet has warned about critical price levels, with the idea that near-term stability hinges on holding around the mid-$60,000. If that area fails, the next air pocket becomes visible. That's exactly the framework we've been discussing. It's not about predicting the next headline. It's about respecting the map. When the map says support is thin here, you don't act surprised when the floor gives way after a shock. At the same time, Andrejka Bernatova has argued that the current bear phase may still be part of a broader adoption cycle, meaning structurally she's not calling this the end of crypto, but a painful reset where weak hands get washed out and long-term positioning rebuilds. That's the split screen you should keep in your head. Short-term price is flows and positioning. Long-term thesis is adoption and time. Now here's where it gets even more interesting. When traditional venues were closed or thin, on-chain oil-linked futures on Hyperliquid surged about 5% after the strikes, with oil USDH perps jumping towards $71 alongside millions in trading volume and open interest. This matters because it shows what crypto has become. Not just coins, but a parallel financial system that reprices macro risk in real time. Traditional oil markets don't trade like that on a weekend. Crypto does. So while Bitcoin was selling off on risk-off flows, another pocket of the on-chain world was pricing in supply shock and energy inflation risk almost instantly. Now let's talk about XRP, because XRP didn't just drift lower, it broke. The key level was $1.36. XRP dropped roughly 9% from around $1.42 to near $1.30 after a high-volume breakdown below that support, flipping it into resistance, with traders watching $1.30 as immediate support. But the deeper story is positioning. When you have an asset like XRP that's heavily traded, highly emotional, and often leveraged in perpetual markets, a clean break of a widely watched level can trigger a chain reaction. Stops get hit. Liquidations accelerate. What looked like a normal dip becomes a fast flush. On-chain data supports that emotional strain. Sentiment highlighted XRP's largest realized loss spike since 2022, roughly $1.93 billion in weekly realized losses. That's the kind of stat that tends to show up near capitulation moments, when holders finally sell at a loss after weeks of pain. Now, a capitulation signal is not a guaranteed bottom. It's simply evidence that fear has reached a point where weak hands are giving up. Combine that with a structural breakdown and a market-wide risk-off wave, and the move makes sense. It's not just reacting, it's deleveraging. Zooming out, this is how reflexive markets behave. ETF outflows weaken price. Weak price kills confidence. Killed confidence increases sensitivity to headlines. Increased sensitivity makes any shock cause sharper selling. Sharper selling triggers liquidations. Liquidations push price into key support. Support breaks, and the chart becomes self-fulfilling. There's also a broader macro link. Strategists like Deutsche Bank's Jim Reed have discussed how skepticism around the AI trade and broader equity positioning has been feeding into risk sentiment, and that risk sentiment bleeds directly into crypto. In regimes like this, correlation comes back hard. Crypto trades with tech. Risk is risk. So how do you think about this practically? If you're a long-term holder, days like today are emotionally brutal, but structurally unsurprising. Your job isn't to win the day. It's to survive the regime. If you're a short-term trader, you either respect levels, liquidity, and leverage, or you get run over. The headline wasn't predictable. The fragility was. When you have weeks of ETF outflows and analysts openly warning about critical mid-$60,000 levels for Bitcoin, that's your warning label. When XRP hovers near a widely watched price floor after weeks of drawdown and realized loss spikes, that's your warning label. When global tensions are rising and the market is already on edge, that's your warning label. Today's episode is sponsored by Kraken. If you're trading or investing in crypto, security and execution matter. Kraken is one of the longest-running major exchanges in the industry, known for strong security standards and a serious, pro-grade platform. If you want a place to buy, sell, and manage your crypto with a platform built for real users, check out Kraken through the link in the description. Now back to the bigger picture. The oil move isn't just a side story. It shows that crypto markets are increasingly serving as an always-on risk transfer venue. When the world is closed, crypto is open. That means crypto will often be the first place people express macro fear, whether that's selling Bitcoin, buying oil perps, hedging volatility, or repositioning capital. Crypto doesn't get hit harder because it's uniquely weak. It gets hit first because it's uniquely available. The ETF outflow story remains the slow gravity here. When money leaves ETFs, it removes the steady bid that supported the market in prior months. The same ETF access that amplified the rally on the way up can amplify pressure on the way down when investors de-risk. So what are traders watching now? They're watching whether Bitcoin can stabilize above the mid-$60,000 zone. They're watching whether XRP holds $1.30. And they're watching whether geopolitical escalation continues, because that variable doesn't care about technicals. Most people don't lose money in regimes like this because they get direction wrong once. They lose money because they keep assuming every dip is automatically a bottom, even when flows are negative and structure is breaking. The market can stay irrational longer than you can stay liquid. The optimistic case is that washouts reset leverage, transfer coins to stronger hands, and lay the groundwork for cleaner bases. The realistic case is that reversals require demand, and demand is being tested. So the correct mindset is disciplined patience. Long-term investors focus on survival and rational accumulation. Traders trade the regime they're in, not the one they wish they were in. If you listen to this show regularly but you're not following yet, take 2 seconds and hit follow. It helps the show grow, it keeps us doing this daily, and it means you don't miss the update when the market flips again. That's the Daily Crypto Roundup. Drop your thoughts in the comments. Is this a temporary geopolitical shock layered onto a weak tape? Or is the ETF outflow pressure the bigger story that keeps grinding this market down? And as always, we will see you at the top.